We all have that stocks app on our phone, right? And when you open it, you're greeted with this sea of green and red. It looks probably something like this. You'll see familiar names like Apple, Google, and right there the S&P 500. In short, this is the stock market. Think of it like a giant report card for the biggest companies in the world. When those companies thrive and innovate, the market goes up. When they face challenges, the market goes down. Now, the S&P 500 is one of the most significant indexes globally. It represents the 500 largest and most influential companies in the United States. Powerhouses like Apple, Microsoft, Amazon, and Google. Now you might be thinking, what does this have to do with me? Here's why it's so important. So if you have a 401k, and an IRA or any other investment account, your financial future is tied to the market of the indexes like the S&P 500. But we all know the market isn't a one-way street. It doesn't always go up. There are years when it goes down. And when your money is directly invested in the market, your account value follows it down. So let's imagine you have $100,000 in your account. If the market drops by 20%, your account is no longer 100,000, it's 80,000. And here's the crucial part that most people miss. To get your account back to 100,000, you need a 25% gain. Why? Because you're now starting from a lower number. You're fighting to get back to even, not growing your wealth. This is the lost time trap that so many investors fall into. Your money isn't growing, it's just trying to recover. Now, I want to introduce you a powerful concept, and it's a game changer. To understand indexing, you need to know that while it's still linked to a major market index like the S&P 500, it follows a different set of rules. This is how indexing works within a specific type of life insurance policy called an Index Universal Life Policy, or IUL for short. With an IUL, there are two key components, a floor and then a cap. The floor is your safety net, the absolute minimum interest rate. In most cases, the floor is 0%. So if the market has a negative year, your account value doesn't decrease due to market losses. You're protected from the downside. On the other hand, the cap is the maximum interest rate you can earn in a given period. So if the market goes up 15%, your cap is 10%. Then 10% is the interest credited to your account. So instead of riding the roller coaster of the markets with the ups and downs, your growth is captured within a predictable range. Now let's talk about another important element, the participation rate. The participation rate determines how much of the market's gain you participate in. For instance, if the market gains 10% and your participation rate is 100%, you'd be credited with the full 10% up to your cap. But if your participation rate is 50%, you would be credited with 5%. Think of it as a dial that adjusts how much of the market's growth is applied to your account. Some IUL policies offer features like multipliers, which can enhance your credited interest. For example, if the market goes up 10%, a multiplier can boost that gain to 12%. It's a way to amplify your returns and accelerate your account's growth potential. And then there are bonuses, which add another layer of growth to your policy. So if the market gains 10%, a bonus might add an extra 1%, bringing your total credited interest to 11%. It's an additional reward that contributes to your long-term financial goals. And that, in essence, is how indexing inside a universal life policy. It's a strategy designed to give you the best of both worlds. So let's bring it all together. On one hand, you have a traditional market investing where you experience all the highs and the lows. You have the potential for high returns, but also the risk of significant losses and the lost time trap. On the other hand, you have the IUL, a strategy that allows you to participate in the market's growth while protecting you from the losses. It's about capturing the upside and then eliminating the downside, and creating a more stable, predictable path to your financial goals. It's about growing your wealth without the fear of losing it. That is the power of indexing.